Thanks, darling, and a very warm welcome to you wherever you are in the world. Good to have you with us today. Just move my chat box out of the way. Hopefully you can hear me okay.
Yes.
Let's just move that out of the way. Okay. We're really just going to concentrate on one workspace. I've got the multiple time frames up. I've got 15-second, 1 minute, 3 minute, 5 minute, 10 minute, 50, and over onto the daily on the right-hand side. I've had the New Zealand yen up because we've had a nice move. But what I actually wanted to show you, I'm just checking over on the right-hand side, see what the VIX is doing. Just to pick up on the sentiment, let's go and have a start with the sentiment. Let's see where the, where are we? There we go. That's it. This is the YM at the top left, middle is the NQ, and over on the right-hand side is the ES. So this is what the major US indices are doing. This is on Globex. Obviously, the cash markets are closed at the moment. But perhaps, you know, it always comes as a surprise to a lot of traders when the nice thing with NinjaTrader obviously is that you actually get your real time is printed in your local time here. So this is 7 o'clock. So this is the open of the European markets. We get through to 8 o'clock, which is the open of the London forex markets, and you get a big surge in volume, which always comes as a great surprise to a lot of traders. Think, well, why is it that markets which are closed and trading electronically, yet they too show the session crossover? And it really does reinforce the point that all these markets are related. Everything in the financial world is related, and it's related through the prism of risk. It is purely about risk on and risk off. It is this constant seesaw of money flowing from safe haven, in other words, lower risk, lower reward, into higher risk assets, higher risk, higher reward, and that's all it's about. And that's why you see this constant flow. It's why they're all related. It's why you see it in even markets which are not open in terms of the cash markets. This is just electronic on Globex. As Anna said, maybe it's fairly quiet today. This is down on the daily. You know, trying to recover after the pretty strong correction we had. And trying to rally, but the principles are exactly the same in terms of the chart analysis and all the rest of it. Let's go back onto the currency pairs multiple time frames. There we go. And I just want to highlight it because if you go to, here we are, it's very clearly displayed in terms of, this is 15-second chart. It's one I use a lot. I'm not suggesting you have to use it, but it's one I like to use purely because first of all, it keeps you very sharp in terms of volume price analysis, methodology, and using it very quickly, making a very rapid decision based on what you see bar by bar, candle by candle. But also because it gives you a flavor of what is coming up at you from this very fast time frame into your trading environment, your 1 minute, 2 minute, 3 minutes, so on and so forth. But I just wanted to highlight it here. This is 7:58, 7:59, London coming up. You know, what do we get? The usual, we get volatility, and we get reversals. It's what you expect to see all the time. As you come to 8 o'clock UK time, that is what you expect to see. It's exactly the same when you get into the US session around about 1 o'clock UK time. You will expect to see volatility, reversals, and particularly so when you've seen perhaps a strong move through the London phase of trading through from 8 o'clock to 1 o'clock, where, for example, you might have seen strong buying in the pound or strong selling in the dollar or whatever it may be. It is often the case that you will see a strong reversal in that sentiment as the new center opens. Now, you can argue and say, well, you know, is that semantics? Is it because the traders want to show who's boss? There's all sorts of reasons in there, but you know, these are the sorts of things you see all the time. So I just wanted to highlight it here on the 15-second. Just shows you exactly what goes on. You've obviously got a repeat of that on the 1 minute. Move over to the 1 minute. What do we get? Volatility. We get, you know, the rally here. We've got volume falling away is what we expect to see. Then we've got selling coming in. We're trading around the volume point of control, trying to break away from that. The trend monitors turn to bright red. If we look at the, we've obviously got the volume point of control here at 94. This is all very tight pricing. It's very quick, obviously. What we're looking for next is a move towards, as this volume here, that's the maximum. It falls away very rapidly down to this low volume node, and we've got very light volume in this region here. So from a trading perspective, if you're looking to short this particular pair, what you have to then assess in terms of taking that particular position, if you're going to go short, is, well, as a scalping trader, how much is this trade likely to deliver for me? And you do that not through the metric of, oh, well, I have to have a risk reward of 2 to 1 and 3 to 1, otherwise I'm not going to take the trade. It's through the prism of the chart. So you will be looking at this chart now and saying, okay, on the positive side, I've got a low volume node here, and I've got relatively low volume here. So from a price move through that region, I would expect that to move pretty rapidly because there's very little in the way of volume to act as support to the price action. Now, obviously, as you're seeing, this is a very fast chart. You're seeing the volume building all the time. It's what you expect to see. This is not a static profile. You know, the volume point of control doesn't stay static. It does move around. If we get, for example, if we move down to this region, this volume gets more than this, then the volume point of control will move down to that level. But volume acts as both support and resistance. It's exactly the same as price-based support and resistance. So if you have low regions of volume on the volume point of control on the histogram here, you would expect the market to move through there relatively quickly. In other words, it will require less effort down here to drive the price action through this region because there is less in the way of orders that are sitting there, old orders, traders locked in weak positions, limit orders, etc., etc., etc. And the other aspect to it is if the market moved through here fairly rapidly, which it did on the way up, as you can see here, went through fairly quickly, the market per se does not consider this area particularly important, and therefore there's no reason that on the way down it should pause at that price area for any other reason. That's a semantic point again, but it is very much part and parcel. When you get these low volume areas, they are unimportant to the market. This is obviously an important area. This is significant down here. So you're now looking at the chart from the trading perspective. So the volume's building. So that's from a volume perspective. Now you look at it from a price-based perspective. What have we got in the way of price-based support, which is likely to come into play and hinder progress of a trade if we take a short? We've got one level down here, which is very strong. This is on the accumulation distribution indicator on NinjaTrader. And what it does, it's very much the analogy I always use, which I can never remember, is the cartoon character, which is Popeye. He used to eat the spinach and his muscles would expand. Well, it's pretty much the same principle here. These levels are drawn thicker, not by me. They are drawn by the indicator itself. You may not be able to see the little numbers down here. This has been tested 6 times. This is 2, this is 2, this is 7 below here. So this is even stronger. So the thickness of the line denotes how often that particular level has been tested and held. In other words, the strength of that region. So when you're looking at it from a trading perspective, we're looking at this potentially coming into play. We've got quite a few of these. We've got this one, we've got this one. These are less important, but basically in this region, and bear in mind, this is a very limited area. This is only 3 pips, remember. So this is a very tight trade. So we've got 3 pips here of very strong potential support coming into play. So in terms of taking a scalping trade, if you're up here at 92, you know, by the time you get down here 87, okay, it's 5 pips. That may or may not be enough for you. If you're trading euro dollar, I wouldn't suggest you trade anything else that tight because the spread will kill you. But if you were trading it, then you know probably euro dollar would be the only one that you could take that on, certainly in that sort of tight range. But it's the principle of how to view the chart as your window on the opportunity that you're about to take. In other words, if I am going to lay out, I don't know what it might be, let's say a couple of pips of risk, 3 pips of risk for a scalping trade, and you're looking at possibly only taking 5 in return from 92 to 87, is that enough for you? Are you comfortable with that? If you are, you take the trade. If you're not going to take the trade. But it's all based on the premise of what you see on the chart and what is likely to cause that particular opportunity that you're about to enter to pause or maybe congest. And of course, that is just on one time frame. Trend monitor's bright red here, you can see still staying, you know, bearish at the moment. That is on just one time frame. You would then be looking at all the other time frames. You'd be up and down, you'd be up onto, this is the 3 minute, see what's going on in terms of the 3 minute. So from a 3-minute perspective, what are we looking at? We've got the 2-bar reversal here. It's a powerful candle combination. We're always looking for 2-bar reversals, because if you overlay this on that, then what have you got in terms of a 6-minute time frame? In other words, double that. You'll have basically a very small body to the candle, something like that, and a big wick to the upper body. So, you know, it's an upthrust, but it's called a 2-bar reversal, or you can call it bearish engulfing, because this candle is engulfing the positive candle alongside it. Either way, the principle, the outcome is very similar. What we're now seeing is that transitional change. And in terms of looking at the opportunity, on the 3-minute chart, it doesn't look so bad. What we've got ahead is we've got very little in terms of price-based support coming in. We've got some down here at 85, so it's pretty much the same. But what we've also got is the volume point of control down at 84. So you can pretty much be assured, once we get through this tiny little wedge here of light volume, we're going to start running into some fairly stiff support, which is going to slow progress. A, because we've got this rapidly increasing volume down to the volume point of control. B, because we've got this very strong level of support coming in there, this red dash line, and it basically encompasses, it encircles the volume point of control. So we've got another one below, very strong above, and we've got the volume point of control itself. So you can almost be guaranteed that if we do manage to limp down to 84, anywhere in this region, that is where the market is going to congest. At the very least, it is very, very unlikely that the market is going to slice through that region, this whole area of potential support here very rapidly, for those reasons that I've outlined. And this is what it comes down to the whole time. You're looking at this opportunity, you're looking at it in multiple time frames. Yes, we have the right direction, but it's pretty sluggish right now. It's not moving very rapidly. You know, yes, it's a scalping opportunity, but what you're also seeing is the use of multiple time frames. You've got the trend monitor here is transition red on 15 second, it's transition red on 1 minute, it's transitioning on 3 minutes. So we know for a fact this sentiment, this change, if you like, is starting to ripple through. And the other analogy, you've heard it many times, is the ripples from throwing a pebble into a pond. You throw the pebble in and the ripples move away from the point where the pebble landed. It's exactly the same here. This sentiment is now rippling through. It's rippling through into 1, into 3. No change on 5 on the trend monitor. You wouldn't expect it right now. But ultimately, if this is a longer term change, then it will go through, obviously, into the 5, out into the 10. And ultimately, of course, if it's a huge change in sentiment, it'll go out to the daily. But you wouldn't expect to see that from a scalping perspective. Obviously, what you're seeing up here on the CSI, this is on 5 minute. We've got the New Zealand dollar here at the top, the gray line. That was starting to roll over. It's now descending nicely. The yen here was down at the bottom, very strongly oversold. And as Anna said, these levels here of 80 and 20, they're really just they're a benchmark. It's not a get-in signal. It's not a signal of anything other than the fact it gives you some sort of metric of where a currency is either approaching or has moved into either an overbought or oversold condition. It's the first point I look at. You all know that. You've come along to these so often, you'll know what I'm going to say. My eye always looks for these levels. I'm always looking at overbought and oversold purely because I'm greedy. I like to get into a trade early. I like to maximize what I can get out of that particular trend. Now, it doesn't mean that that is the only way to trade, and it comes at a higher risk because in taking those trades, there's 2 things you have to have. First of all, you've got to have patience, because in this occasion, it has actually reversed pretty rapidly, but this is not always the case. You will often find that currencies will stay up here for quite some time. They'll flip-flop around, but ultimately they will move because this market is one of mean reversion. In other words, currencies have to move from overbought and oversold continuously. They may stay there for a while and stay there for a long time, but ultimately they've got to move because that is what they do. It's like an oscilloscope. If you've seen an oscilloscope, basically it's a sinusoidal signal. In other words, it's constantly oscillating from high to low to high to low to high to low and back again in this metronomic way, and it's pretty much what you see in the forex world. So in terms of getting in, A, you have to be patient. B, you've got to put more risk on the table because you have to allow for this buffering. The Swiss franc up here, at some point this is going to roll. I don't know when it's going to roll, but it will roll over and it'll start selling off again. And you have to allow for this oscillation up here between 80, 90, maybe up to 100. So you have to set a wider stop loss. You can't avoid that, because in this business, it's all about risk and reward. If you put more risk on the table, you should be rewarded with a higher reward, higher profit. And that's what you get by getting in early. It's as simple as that. Now what we're seeing, some of the Johnny-come-latelys will be jumping into this trend because we've got a nice cross. The New Zealand yen is falling nice and strong. The steepness of the line, as Anna said, it really gives you a very, very clear signal as to how strong that selling is. And equally, you've got very strong buying of the Japanese yen. And if we head over onto the indices, I'll do it in a moment, then we should see those sort of selling off a little bit, because obviously risk on that was prevailing here has now reverted to risk off over here. Just keeping an eye and see what's going on in terms of the VIX. I'll pull that over in a minute. So, this trade is now developing. If you've got into it early, you've got some profit already. A lot of traders will be looking at it and think, oh, this is going lower, so I'm going to jump in now. We've got a cross here. And, jumping on an existing trend is fine. All it means is that you've given up some of that trend that's already gone. You can't claw that back. You've already lost all this. So you've got to just forget about that. You're jumping onto a trend that's underway. The quid pro quo is that in doing that, you're jumping on a moving train. The train's left the station. I got on the station when it was still sat in the platform. I didn't know how long we were going to be there. All I knew is that at some point it would move. You're jumping on the train as it's underway. You're benefiting from that momentum of the trade, and the stop loss that you put on will therefore be that much tighter. You haven't got to put so much risk on the table because you're already in a momentum trade. It's as simple as that. So what you're seeing right now, again, you're back to multiple time frames. We've got a little bit of a rally going on here on 15 seconds. Is that enough to worry as a scalping trader? It might be if we just hop up here onto one. What have we got here? We managed to get through this very strong level of what was at the time support, is now acting as resistance, but we then hit this next level down here. We've got lots of volume. We're driving into an area of high volume. We've also got support coming into play, and this little cluster here, we've got a stronger level and a slightly weaker level below it, but it's enough to cause that market to bounce and pause. You've now got this very strong ceiling overhead, which may be enough to just cap it off if there is any rally. Just looking at the volume profile down here, we've got rising volume and rising price. So, it's giving us a sense that there is some positive momentum towards this, but it's a question of whether this is going to hold. And if this breaks, if we break through here, then we've got two nice levels above, which are going to add some pressure to the downside. And what the trend monitor was designed to do, very simply, was to give you that confidence to hold the position. You see this coming, your reaction is, oh my gosh, I better close out, take what I have, head for the hills. And if you do that constantly, what you will end up with is a series of small losses and a series of small profits. And basically your trading account will probably either flatline or slide lower, purely because you'll have more small losses than you have small profits. And the key to this business is really not about understanding everything, understanding the charting, understanding the mechanics of trading, understanding how the markets work, how to use the indicators. It is about this whole business of managing to stay in a trade once you've got some profit in it, and maximizing what you can from that particular opportunity, it really goes back to what I was saying about where you get in, which is why I'm always looking at the extremes up here, because I like to get in early, because in that way, at least I can maximize the profit potential, hopefully before we hit some congestion phases, which is where the emotional pressure comes on. And that's what the trend monitor was developed for. You can see here a little bit of transition back into red again. No flicker here, hasn't changed. We've got some congestion building here, but no change. Same sort of thing here. We've got support coming into play here. And this is the way, this is the hardest thing to do in trading, is to stay in a position once it's moving in your direction and not to be flicked out on an emotional response to, oh my gosh, take my profit off the table. It is a natural response. We all suffer it. We can't avoid it. It's in our DNA. It's built into us, hardwired into us to not lose something that we've already gained. It's as simple as that. Just Just going up onto the 10 minute, and I'll pass back to Anna. And you can see here on the 10 minute, you know, we had this, again, a completely different perspective on the opportunity, but you could see the weakness coming in here, you know, around about, just as we're heading up into the London Open. You've got this nice up thrust candle, nice big wick to the upper body, good volume under there. And, you know, it's ahead of the London Open. So it's really telling you all that you need to know, and we're starting to approach down to the VPOC here as well. So expect some congestion. We've also got some support coming into play here. So again, you know, several reasons to think that this isn't going to crash through here. We're going to find a congestion point around the 84 level. So it's not going to move that much further. I'm going to pause there and pass back to Anna.